Let's start simple. Imagine you open a coffee shop. Business is good, really good. You want to expand, open a second location, maybe a third, but you're out of cash. You've got two options. You can borrow money from a bank, that's debt, or you can sell a piece of your business to someone else. That piece, that's a stock, a share. When you buy a stock, you're buying actual ownership in a real company. You become a part owner of that business. When you buy a share of Apple, you literally own a tiny fraction of every iPhone sold, every MacBook shipped, every service subscription renewed. You're not betting on Apple. You are Apple, just a very, very small piece of it. Now here's where it gets interesting. If Apple makes more money, your slice of the pie becomes more valuable. If they tank, so does your investment. This is the fundamental deal of the stock market. You give companies your money, they use it to grow, and if they succeed, you profit alongside them. But how do you actually be? You've probably seen images like this. The New York Stock Exchange, traders yelling, chaos everywhere. It looks like controlled madness, and honestly, it kind of is. But the stock exchange is simpler than it looks. It's just a marketplace. Think of it like eBay. But instead of selling vintage sneakers, people are buying and selling ownership in companies. The two biggest exchanges in the US are the NYSE, the New York Stock Exchange, and the NASDAQ. Combined, they're home to companies worth over $50 trillion. Now, here's something most people don't realize. These days, the trading floor you see on TV, it's mostly ceremonial. Over 99% of trades happen electronically, executed by computers in milliseconds. When you tap buy on your phone, your order travels through your broker, hits the exchange's matching system, finds someone willing to sell at your price, and boom, the trade executes, often in less than a second. But here's the question that should be bugging you. Who decides the price? Why one stock, $50, and another $3,000? Stock prices come down to one brutal, simple truth: supply and demand. That's it. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, it drops. But what makes people want to buy or sell? This is where it gets fascinating. Factor 1. Earnings. Every quarter, companies report how much money they made. Beat expectations, stock usually rises. Miss them, watch out below. Factor 2. News. A new product launch, a CEO scandal, a lawsuit. Information moves markets, sometimes rationally, sometimes not. Factor 3. The economy. Interest rates, inflation, unemployment. These big-picture forces push the entire market up or down. Factor 4. Sentiment. This is the wild card. Sometimes people buy just because everyone else is buying. FOMO is a real market force, so is panic. Remember GameStop in 2021? The company wasn't suddenly more valuable, but millions of people decided to buy at once. 1,500% in weeks. Here's the uncomfortable truth. In the short term, stock prices can be completely disconnected from reality. A company's stock can crash even when the business is fine. It can skyrocket even when the company is bleeding money. But over the long term, years and decades, stock prices tend to follow actual business performance. The market is a voting machine in the short run, but a weighing machine in the long run. That quote is from Benjamin Graham, the father of value investing and Warren Buffett's mentor. Remember it. So who's actually in the market, moving all this money? Let's break down the players. First, there's retail investors. That's you and me. Regular people buying stocks through apps like Fidelity, Schwab, or Robinhood. Retail investors make up about 20 to 25% of daily trading volume now, way up from a decade ago. Then there are institutional investors, pension funds, mutual funds, hedge funds, insurance companies. These are the giants. When a pension fund decides to buy, then there are institutional investors. Pension funds, mutual funds, hedge funds, insurance companies. These are the giants. When a pension fund decides to buy, they're not grabbing 10 shares, they're buying millions. They move markets. And then there's the silent majority, algorithmic traders, computers running complex strategies, executing thousands of trades per second. Some estimates say 60 to 70% of all trading is now done by algorithms. Here's the thing. You're not competing against the person next to you at the coffee shop. You're in the same pool as billion-dollar hedge funds and machines that trade faster than you can blink. That sounds scary. But it's also why most financial experts say the same thing. For regular people, trying to beat the market by picking individual stocks is incredibly hard. Most professionals can't even do it consistently. Which brings us to the most important question. Understanding how the stock market works is one thing. Using that knowledge, that's another. Here's what decades of data actually show us. The U.S. stock market, measured by the S&P 500, has returned about 10% per year on average over the last century. Not every year. Some years it crashes 30%, others it gains 30%, but averaged out about 10%. That means if you invested $10,000 and just left it there, reinvesting dividends, you'd have roughly $67,000 in 20 years, without adding another dime. That's the power of compound growth. The catch? You have to stay in. The worst returns happen to people who panic sell during crashes and miss the recovery. Here's a stat that should blow your mind. If you miss just the 10 best days in the market over the past 20 years, just 10 days out of over 5,000, your returns would be cut in more than half. The market rewards patience. Oh, that's how the stock market works. It's a place where people trade ownership in companies. Prices move based on supply and demand, driven by earnings, news, economic conditions, and pure human emotion. The players range from you on your phone to supercomputers executing trades in nanoseconds. But here's what I want you to take away. The stock market isn't some mysterious casino reserved for Wall Street elites. It's a tool, a wealth-building machine that has created more millionaires than almost anything else in history. You don't need to be a genius to use it. You just need to understand how it works, which you now do. If this video helped you see your money differently, hit subscribe. We're going deep on personal finance, investing, and how money actually works in the real world.